Hello, welcome back to Stockshark. Today's episode, we would be looking at top 10 ETF and stock that most of the traders use them for option trading. Usually, you find these ETF and stocks on their desktop all the time. They watch this, right? So let's dive into the detail. So before we get into the actual script, what actually most of the traders use to spot on, identifying the script for option trading. And once they identify them, they actually keep using them on daily basis or weekly basis, right? It's not like a done deal one time, right? They always use the same script again and again and again for increase the odds. So what are the simple criteria? First of all, I would look at liquid script that trade anything more than 5 million on daily volume. That is key. Otherwise, bid and ask spread would be really, a large one. I want to see a tight bid and ask spread. The second one is it should be volatile. If it stays the same, generally, it's not suitable for option trading. In the sense, maybe covered call, it's okay, but usually you don't make money if it is not volatile. So most of the successful traders make money on volatile script. Then bid and ask on the option table also should be tight. You find some stocks like Google or Amazon look like a liquid, but if you look at bid and ask on their strike prices in the option table, they are very, very large. So what it means is it could as large as a dollar or two between bid and ask. You don't make money if you have that type of bid and ask spread. So look for something very tight within 5-10 cents between bid and ask. Then the last one is I would look for very high open interest, at least 100 to 150K on the volume side for most of the strike prices, or whether it is ETF or stock. I would look at open interest in the option table. That represent how many contracts are opened, right? So you can trade with the confidence. So that's it. These are the simple criteria the most of the professional traders use to spot on a right script for option trading. Let's move on to the next screen about what are the top ETF one would look for option trading. So top 5 ETFs most of the professional traders use. The first one is SPY, that represent S&P 500 stocks. It is usually suitable for buying or selling the spread. Also, it's suitable for buying, buy to open calls or puts. Depends on the macro picture that I explained in the previous video. If you don't watch, please go and watch that. Basics of option trading, where I would have explained about top 3 strategy for option trading. Anyway, so SPY is really suitable for spread buying and straight naked call inputs. Then you have a triple Q that represent Nasdaq 100 stocks, especially given the FANG stock weightage in it. Triple Q moves a lot up and down on daily basis. Traders really make money on this. I would say it's suitable for everything, right? Covered call or spread, but I generally prefer triple Q to buy straight, buy to open calls or puts. Then IWM, again, this represents small cap universe and highly volatile. So again, traders love this type of volatility, so they jump into IWM. So it's a suitable for spread because it's highly volatile. If you buy naked calls or puts, the odds of success is very low. So spread would limit that risk. So I would go for spread whenever I jump into IWM. XLF, again, it represents financial stock within S&P. It's suitable for covered call because I use them to do this covered call writing because it doesn't move that much. It's very predictable, especially on the monthly candle. So I usually do this for income generation. Same thing with XLE that represent S&P energy stocks. so it's really suitable for call selling. So so this screen that explains you top five ETF that professional traders most of the time use. Next screen we will look at top five stocks for option trading. Even though most of them changes month to month, it depends on which one it's into favorable seasonality outlook. But in general, this is very in general with that context, right? That the following would be representing the top five. The first one is Apple. I love Apple. It's very liquid, lot of open interest, and I use them time to time for buying or selling the spread. So I love it. And then Facebook. The one disadvantage with Facebook is it's highly volatile. The stock go up, down like $5, $10. So you got to be very careful with this. But it's liquid though, and you can quickly enter and exit. I would prefer to do this naked call or put if my technical understanding on the script favors it. Then XYM, that is Exxon, it's good for covered call rating. I do that. It's a lower volatile and it's very predictable moves on monthly candle chart if you look at. So I use them for doing covered call rating. Tesla, everyone's favorite, right? But it's highly volatile. Um, but I use them for on a really quick day trading on buying calls or puts, depends on the technical picture on the day. I don't hold this option for a long time, right? I choose just do this for a day or two. That's it. That's how I use Tesla. It's highly volatile. Then the fifth one is JP Morgan, JPM. Again, it's suitable for covered call rating because I have JPM and XOM for my long-term portfolio. So I use this covered call rating to generate some income. It's very low return, but the risk is low as well. So that's why I use that. And I seen with from my colleagues and my friends, most of the professional traders use very similar script in line as well. So that's all, folks. I think my this presentation would probably find a bit of helpful to you for your next next week trading plan. All right, good luck. Thank you.